Greetings and welcome, guys, to the Wealth for Real YouTube channel. I'm Christopher Anastasio, your host. It is Thursday, April 13th, 2023. And I just wanted to make you guys this video about an article that I posted on the Facebook page, which I'm looking at right now as we speak. You can see my screen. And went ahead and took this article and posted it to Instagram stories today, made some commentary there. If you guys follow my Instagram page, wealth_for_real. And I just wanted to kind of go through it in a little more detail with you on this video, get a little bit more in depth with it. If you see here, posted it, actually thought I posted it this morning on Facebook. It didn't take. So it was on Instagram all day and I had to put it here now. But it was on CNN's business section. I'm going to go ahead and click over to that so you guys can kind of follow me over here. And you can see this article was published today, titled "This Investor Can Spot Market Bubbles. Now He's Warning of an Ominous Bust." And they're referring to Jeremy Grantham. Jeremy Grantham is fairly famous in the investing community. Let's take a look at, if you guys follow me over here to his Wikipedia page. British investor, co-founder of Grantham, Mayo, and Van Otterloo, Boston-based asset management firm, $118 billion under management. So pretty serious guy. Let's see, he was born in Hertfordshire. This is from UK. All asset classes market will revert to mean historical lows, highs, and lows. So it gives you a little sense if you guys want to Wikipedia this guy. He's been around for a while. He's 84 years old. So Jeremy Grantham is kind of a big deal. I mean, I recognized his name when I saw this article, and I knew that he was somebody who could weigh in on something like, are we going to have a recession? What's happening with the economy? Things like that. But there were a couple points in this article that I wanted to highlight for you guys. Certainly encourage you to go read it, take a look at it on your own, and would love to know what you think about it. If you guys watch my welcome video, I am no expert at any of this stuff. I'm just really enthusiastic about it. I'm a real estate investor who has assets sort of at play here in this economy and in the real estate sector. So I have some experience with that, some direct hands-on experience with that. But I'm a macroeconomist by hobby. I just read a lot of stuff about it, and I've really kind of put my head into it, trying to wrap my arms around, where's this next crisis going to come from? What's the next thing that's going to kind of happen to us here, like 2008? So I'm really on the alert for stuff like this. And so as you can see here, at the beginning of the article, it starts right off the bat with the fact that Grantham predicted the dot-com crash in 2000 and financial crisis in 2008. Now, what they mean by predict, I don't know. I don't know if he exactly called it or if he was just doomsaying for years on end, kind of like a Peter Schiff or something like that. So I don't know for sure, but it's interesting that they listed this right off the bat. It was something I'd like to follow up on my own. So he says here, other things are going to break. Who knows what they will be? We're by no means finished with the stress of the financial system. So he was kind of reacting, I think, to this banking situation like SVB and First Republic and Signature Bank, like that whole perturbation in the system is what he's responding to here. And he goes on to say here that the COVID pandemic created one of the greatest bubbles in financial history. I think what he's basically referring to there, guys, amongst other things, just doing my own research, is that we went into the pandemic. So like in 2019, when I looked up the Fed data, we had $14 trillion in circulation, was the money supply data that the Fed had. By the time we came out of the pandemic, so the most recent data, I forget exactly which month it was, but it's fairly recent, was like 21 trillion. So if you take the 14 trillion from 2019, take half of that, tack it on, 50% of the money in circulation in 2019 got added to the money in circulation by the time 2023 came around. So this massive, massive expansion of Fed balance sheets and asset valuations and money in circulation, the whole thing getting blown up like that, is what he's probably referring to here when he says one of the greatest bubbles in financial history. I mean, I don't think you have to be a rocket scientist to know that that's probably what he's referring to there. So he said since early 22, stocks are up about 15%. Central banks jacked up borrowing costs. Of course, the higher interest rates have led to contraction and issues like that. So then he says here, this is kind of like probably the key line in the article. The best we can hope for is a fall of about 27% from current levels. And he's talking about stocks coming down 27% while the worst case would see a plunge of more than 50%. I think a lot of people, when I put this out there, I saw a lot of reactions like, "Oh my God, what are you 50%? What are you talking about?" Like, you guys got to remember, like, the stock market fell, the Dow Jones fell 57% from October '07 to March '09, right? October '07 was its high at like 14,000 and something like that. Let me see, October 2007 Dow Jones. There you go. The Dow Jones Industrial Index and S&P 500 peaked on October 9th, '07. And then, this is good. They actually have the whole chart here. October 9th, '07, March 9th, 2009, 65.47. The day that the Dow Jones, S&P, and NASDAQ bottomed. So peaked, bottomed. Okay, so let's just do the numbers there. Let's do, here, I'm going to do it on my phone real quick so we don't distract too much here from the screen. So let's take 65.47 divided by 14,165. Okay, so about 54%. It fell 54% between October 9th, '07 and March 9th, '09. So you guys can see that data right there on Wikipedia. So I don't think these numbers are that crazy. I mean, if we have a recession or a depression bigger than 2008, maybe it goes down more than 50%. Maybe it goes down 60, 70, 80. Who knows? Maybe it goes to zero. I have no idea. But this is a really interesting data point that he throws out there. So he comes down here and he talks about, or not he, this is the article, not Grantham. Stocks aren't the only assets to notch excessive valuations when cheap money encourages investors to take big risks. Of course, artificial, right? When we print money and we dump money into the system that wasn't really generated by productivity, we just create artificial market forces, right? So those artificial market forces created these outsized valuations. Okay, prices of government bonds went up. Why did prices of government bonds go up? Because as yields came down, right, the more the easy money was out there, right, the lower the interest rates were. Those government bonds were yielding very little. So bond prices, guys, are like a seesaw, right? So low bond yields equals high bond prices, okay? So price of government bonds, real estate, cryptocurrencies shot up. It says widespread exuberance could lead to particularly harsh reckoning, according to Grantham. A recent failure of SVB triggered in part by losses on bond holdings as interest rates jumped and prices of U.S. government debt fell. So there you go. There's the seesaw, right? The interest rates came up, the government bonds worth less. Okay. Economic downturn is certain to occur after, or all but certain to occur. Every one of these great bursts of euphoria, the great bubbles of the overpriced market, has been followed by a recession. Recessions are mild if everybody does everything right and there are no complications. They are terrible if people get everything wrong. In the meantime, investors count on being surprised. Let's say difficult to predict implosion of Silicon Valley. Just looking for some of the other data points I want to show you guys here. When great bubbles break, they impose a lot of stress on the system. It's like pressure behind a dam. Okay. Let's see. Economists at Federal Reserve predicting a mild recession late 2023. So this is interesting, guys. So the Fed minutes that got published a day or two ago basically actually mentioned recession. That's very rare that the Fed would even put that into its minutes. I actually posted a video on TikTok, guys. You follow me over there, Wealth for Real on TikTok, where I had behind me on the green screen a tweet from Peter Schiff of all people. I mean, there's many people we're talking about. I just happened to grab his tweet where he said, hey, the Fed minutes actually mention a recession, but if they think it's going to be a mild recession, that means it's going to be a gigantic recession because they get everything wrong all the time. And to be honest with you, as much as Peter Schiff has been a doomsayer for years, I mean, he's been a doomsayer since the 2008 recession happened, he has a point. It's interesting the Fed actually mentioned that word. The Fed always gets everything wrong. So if they think they see a recession that's mild, it would be reasonable for us to fractally imagine that it's going to be enormous. Right. So that's why I put that out there. Guys, we got 45,000 views on TikTok as of this morning. So if you guys want to go check that out. So let's see. It says here there'll be the opportunities in this environment. GMO has a U.S. equity fund with Apple, Microsoft, ExxonMobil, Kroger. In the short term, almost everybody gets hurt as asset prices come back down to earth. Let's see. Uncomfortable parallels between markets today in 2000. Explosion in the price of tech stocks. At a dizzying crash. Echoes of 2008. Painful come down in the U.S. housing market. What's even more worrying is that this time bubbles in the stock market and real estate market are poised to burst simultaneously. That's a really interesting point there, guys. In Japan, here's the corollary. In the early 90s, there was a long period of economic stagnation because of that. It's because of those dynamics. Let's see, what else did I want to show you guys in here? Okay, so here's a big one, guys, because if you're looking like, okay, where is the, not necessarily what's the only thing that's going to get hurt. I mean, in 2008, everything got hurt, right? It started with subprime mortgages, then spread to all mortgages, then spread to like credit default swaps, and then everything blew up, and didn't matter what you had, it went down, except maybe gold. But this time, if you say, well, where's it going to come from? Like, which is the first domino that's going to knock everything down? It's a lot of people pointing to commercial real estate. So take a look at it. Fears have grown in recent weeks. This sector relies heavily on debt financing. Has been hit hard by rising interest rates. Popularity of remote work been particularly difficult for offices. A market Grantham quipped was in ragged disarray. Can't really disagree with him there. So home prices hit record highs 2022, but it started to drop. Okay. So it says here, when Grantham talks about the way out, he blames central bankers for the emergence of the latest market bubble, pursued policies that drove up value of financial assets. Every Federal Reserve chairman has followed the same policy. But Jerome Powell, the current chair, would be wise to follow Paul Volcker. Raised interest rates to unprecedented heights to fight inflation, curbed prices, but policies led to a series of recessions. Consumer inflation. So basically, like if Grantham got his wish, we're possibly going to see interest rates like in the early 80s, late 70s, went as high as like 20, 22%. I mean, I don't think anybody could imagine that was possible just a short time ago. But here we are feeling a lot of pain with interest rates in like the 5% range or something. Fed funds rate is like 4.75 or 5, something like that, right? So let's just see today Fed funds rate. So we get this 4.83%. So I mean, we're at 4.83 and we are hurting. And yet in the Volcker days, which Grantham is kind of harking back to, we saw rates go as high as 22%. So bottom line, guys, is, I mean, I just wanted to show you this article, kind of walk through it a little bit with you. I'm digesting it real time with you guys. I don't know exactly what's happening, or I'm not pretending to. I just look at this and the brain is like, okay, what's next? Where can we go next with this stuff? What's going to happen to real estate? Should I wait? Should I hold off? Should I buy property? Should I not buy property? Should I re-enter the stock market, which I haven't been in since 2015? So that's, these are the types of things that I'm looking at, trying to work my way through those types of questions. So hopefully this article was helpful to you guys. Like I said, if you want to go find it, you can find it over on my Facebook page right here. I posted it just about 20 minutes ago. But you can also Google it or find it on CNN. But yeah, just take a look at Grantham if you're not familiar with him, or if you want to see what his credibility is. But would love to hear what you guys think about, about this situation, about this article, where you guys see things headed in your own right. I would be very interested in what other insights are out there, and how somebody can pivot for this coming commercial real estate crash that spreads elsewhere, kind of a thing. So if you guys get a chance, please drop a comment or a question below. Make sure to subscribe to the channel, and thank you so much, guys, for watching today.